You're sitting there, scrolling through your feed, probably distracted by some meaningless political circus or the latest celebrity scandal, while the very ground beneath your financial existence is being re-engineered in the dark. They just did it. They passed a 287-page structural overhaul of the entire banking architecture in less than 24 hours, and they've timed the go-live for this coming Monday morning. The mainstream talking heads on CNBC and Bloomberg are already warming up their teleprompters, ready to feed you the scripted lies about modernizing the financial framework and ensuring long-term stability. But I've spent enough years on the inside to know that when the regulators move with this kind of desperate, midnight hour speed, it isn't about modernization. It is an emergency surgical procedure on a patient that is already brain dead. They aren't fixing the system. They are building a fence around the remaining loot. Let's look at the institutional framing they're using to keep you calm. They're calling this the finalization of the Basel III Endgame, a term so boring it's designed to make your eyes glaze over before you reach the second paragraph. But if you have the stomach to look past the bureaucratic jargon, you'll see that they just fundamentally redefined what value means for a Tier 1 bank. For decades, these institutions have lived on the paper illusion, using your deposits to leverage into infinity through derivatives and unallocated contracts. But as of Monday morning, the rules of the game have been flipped. The gatekeepers have decided that the paper you think is wealth is now a liability, and the hard assets they've spent 40 years suppressing are suddenly the only thing allowed to sit on a bank's balance sheet as risk-free. This isn't a safety measure for you. It's a liquidation event for them. The big desks at Goldman and J.P. Morgan didn't get caught off guard by this 24-hour rush. They're the ones who wrote the schedule. They've spent the last 6 months quietly unloading their paper positions, the same liquid alternatives and diversified ETFs they sold to you as safe havens. And they've been hoarding physical Tier 1 assets in vaults you'll never see. They are locking the liquidity doors while telling you the air conditioning is just being optimized. By the time the markets open on Monday, the paper-to-physical ratio is going to experience a violent, regulatory-driven revaluation. They are forcing a structural shift that makes holding your currency or your digital IOUs a mathematical death sentence for the institutions that hold them, which means those institutions are now incentivized to dump you. Think about the timing. They pushed this through in a frenzy, timed exactly with the Lunar New Year and the Monday Open, specifically to catch the global physical markets in a blind spot. They need to re-anchor the ship because the internal plumbing is currently clogged with the rotting carcass of a $3.7 trillion commercial real estate debt bubble. They can't hide the smell anymore with extend and pretend accounting tricks. So they changed the rules. They've reclassified physical gold and silver as Tier 1 assets, giving them the same 0% risk weighting as cold, hard cash. But ask yourself this: if gold is now legally the same as cash, what does that make the actual cash sitting in your bank account? It makes it a Tier 3 liability, a toxic asset that requires the bank to hold more capital just to keep it on the books. Starting Monday, your bank isn't your partner. It's a predatory organism that has been told by the Bank for International Settlements that you are a burden. The new net stable funding ratio requirements, the hidden heart of this Monday rule, make the bank's naked short positions and paper manipulations a capital nightmare. They are being forced to show the metal or face insolvency. But they don't have the metal, and they certainly aren't going to give you theirs. They are going to use the footnotes of this new rule to protect themselves at your expense. While you're worried about your diversified portfolio, the regulators have just finished the blueprints for a system where your access to your own wealth is the first thing to be sacrificed to save the institution. The end game isn't for the banks. It's the end game for the illusion of retail wealth. You've been told this is about resilience, but in the dark rooms where I used to sit, we called this harvesting the exit liquidity. Monday is the day the harvest begins. Let's perform a surgical autopsy on the carcass of this market and see what's actually rotting inside. Because the numbers don't lie, even when the regulators do. We are staring at a $3.7 trillion hole in the commercial real estate sector that has finally reached the point of total structural failure. For the last 2 years, the banks have played a desperate game of extend and pretend, rolling over bad loans and pretending the valuations of half-empty glass towers in Manhattan and San Francisco hadn't plummeted by 60%. But the clock ran out. That hidden rot is now a systemic infection that is leaking into the core Tier 1 capital ratios of every major regional player in the country. This isn't just a market correction anymore. It is a total evaporation of collateral value. While you are watching the S&P 500 grind higher on the back of 5 artificial intelligence stocks, the actual foundation of the banking system was turning into wet cardboard. The Fed's balance sheet is a graveyard of toxic waste that no private buyer will touch with a 10-foot pole. They are still sitting on trillions in mortgage-backed securities that are essentially worth pennies on the dollar in a real-world liquidation scenario. They've been trying to quantitatively tighten their way out of this mess. But the reverse repo facility, the emergency reservoir of cash that keeps the plumbing from exploding, has been drained bone dry. The excess liquidity that was sloshing around the system is gone. We are now in a liquidity desert, and the only way the big banks can keep the lights on is by cannibalizing the smaller players. This is where the G-SIB surcharge comes into play. It's a calculated tax on being a global systemically important bank, but the recent adjustment passed in that 24-hour window wasn't meant to stabilize the big guy. It was designed to punish any institution that dares to hold volatile paper assets, meaning the very stocks and bonds you have in your retirement account are now officially a liability for the banks that hold them. And then there's the FDIC's latest move, raising the insurance limit to an astronomical $10 million for mid-size banks. Ask yourself why they would do that now. It's a blatant, desperate bribe to keep your money trapped in the failing regional system. They need your deposits to stay exactly where they are, so they can be used as the bail-in fodder when the systemic collapse hits. They are painting a target on your back while telling you that you're fully insured. It's a psychological operation to prevent a mass exodus of capital into the Big 8, too big to fail institutions before the ghost protocol is fully triggered. The smart money in the dark pools has already seen through the charade. Since last December, the institutional flow has been moving at a record pace into 90% cash and physical assets. They aren't investing anymore. They are bunkering. Look at the footnote 42, buried deep within the new Monday rule. This is the kill switch. It explicitly allows for the temporary suspension of withdrawals if a bank's Tier 1 capital ratio falls below the 4% threshold. In any other era, that would be called a bank holiday. But in the new endgame architecture, it's just a regulatory stabilizing measure. Most of these institutions will hit that 4% trigger by Monday noon, unless they radically revalue their physical gold holdings to offset the massive losses in their bond portfolios. Treasury yields are already decoupling from reality. The market has stopped believing that the Fed has any control over the long end of the curve. The bond vigilantes are back, and they are demanding a price for debt that the U.S. government cannot afford to pay. The entire debt-based paradigm is crashing into a wall of mathematical impossibility. This is also the moment they fully integrated Operation Choke Point 2.0. By using these new capital standards, the government can now effectively cut off any business or individual they deem high risk by simply making it too expensive for a bank to hold their deposits or process their transactions. It's a social credit system disguised as risk-weighted capital requirements. They've timed this entire operation to catch the Asian physical markets off guard during the Lunar New Year, ensuring that by the time the rest of the world wakes up on Monday, the new gated system is already in place. The plumbing has been redirected, the exits have been narrowed, and the paper-to-real bridge has been burned. You are standing on the wrong side of that fire, holding a handful of digital promises that are about to be re-indexed to zero in the eyes of the global regulators. This isn't a theory. It's the internal logic of a system that has decided to save itself by devouring its own participants. The Ghost Protocol is no longer a theoretical exercise for the paranoid. It is the atmospheric pressure of the world you are breathing in right now. The time for what-if scenarios and let's wait and see is officially over. If you're still waiting for a buy signal from your local brokerage or a reassuring nod from a wealth manager who hasn't seen a real crisis since they were in diapers, you are already a statistical casualty. These people are trained to keep you in the killing fields until the very last drop of liquidity has been extracted from your accounts to satisfy the margin calls of their institutional masters. My verdict is as cold as the data that drives it. This new banking rule is the final closing of the border. They have effectively built a regulatory wall between the real economy, held by the elites, and the paper illusion that you've been told to call your net worth. You must immediately execute a psychological purge of the buy the dip instinct. In the era that begins this Monday, the dip is no longer a temporary discount. It is a permanent structural devaluation. We are witnessing the psychological execution of an entire generation of retail investors who were taught that markets always go up because the Fed will always print. But the Fed has run out of runway, and the end game requires a sacrifice. They want you to provide the exit liquidity for the hedge funds and the big bank desks that are currently burning the midnight oil to escape the blast zone of the commercial real estate collapse. Every time you average down on your favorite tech stock or that regional bank you think is too cheap to ignore, someone in a bespoke suit in a high-rise is averaging out, using your capital to fund their own survival pod. They are using your hope as a financial tool to secure their transition into the new asset-backed paradigm. Your personal survival protocol begins with the radical elimination of counterparty risk. If your wealth exists only as a flickering number on a screen, and that screen is owned by an institution currently scrambling to fill a Tier 1 capital hole, that number isn't yours. It's a suggestion of wealth that can be revoked at the stroke of a regulator's pen. Anything you do not physically hold, control, or have direct title to is a paper proxy and a liability. If you are holding ETFs like GLD or SLV, you are holding the very unallocated paper liabilities that this new rule is designed to penalize. You are standing on the wrong side of the regulatory wall, holding a claim on a vault that has already been emptied by the banks to satisfy their own NSFR requirements. Withdraw the excess immediately. Anything above your immediate 30-day survival needs in a standard bank account is essentially a zero-interest loan to a bankrupt entity that has already been legally empowered to restructure your deposit into a frozen equity stake during a bail-in. Identify the hidden gaps and the systemic rot that they are trying to paper over. Look at the institutions with the highest exposure to the trillion-dollar ghost office buildings that populate our cities. If you are parked in a regional bank that was just promised $10 million in FDIC insurance, you need to realize that a promise is only as good as the entity making it. That promise is backed by a government that is $37 trillion in debt and is currently printing money just to pay the interest on previous debt. A promise from a liar and a thief is worth less than the air used to speak it. The transition from this paper-based illusion to a physical-based reality is going to be violent, chaotic, and intentionally disruptive. It has to be. You cannot unwind 40 years of a credit-based fantasy without a hangover that lasts a decade. This is a wealth reset in its purest form, designed to separate the informed from the invested. The midnight rule passed this weekend was the final flare in the sky. They didn't pass it for safety. They passed it because the internal plumbing of the old system fundamentally broke at the close of business on Friday, and they needed a new set of rules by Monday morning to keep the facade from crumbling before they could finish their own exit. The gears are grinding, the cabin is filling with the smoke of hyperinflating debt, and the captains of industry have already put on their parachutes. You can stay in your seat, clutching your diversified portfolio and trusting the institutional framing that everything is under control. Or you can look at the blood on the floor and realize that the only way to win a rigged game is to walk away from the table before the house locks the doors. The rules changed while you were distracted. Monday morning, you will wake up in a different financial dimension, where the definition of money has been rewritten in the footnotes of a document you never read. Whether you wake up as a predator who understood the movement of the dark seers, or as the prey who waited for the news to be confirmed by the very people who robbed you, is entirely your responsibility. I have done my job. I have dragged the endgame out of the shadows and into the harsh, unforgiving light. I have shown you the data horror and the institutional framing that is being used to blindfold you. Now you have to decide if you have the stomach to survive what is coming. The shadows don't care about your long-term plans, your retirement dreams, or your sense of fairness. They only care about the mathematical reality of the vault. Stay alive or don't. It's your choice. The Monday Open is coming, and it doesn't take prisoners.